While investors scan the horizon for a sudden stock market crash, a quieter, more persistent threat is already draining value from the American economy. The Personal Consumption Expenditures Index is the Fed's preferred way to measure inflation. They target 2%, but August 2026 data sits stubbornly at 3.7%. When we strip out volatile food and energy, core PCE remains clear at 3.3%, still well above the level the Fed considers stable. Inflation has shifted from a series of explosive price spikes to a permanently elevated baseline. This high plateau quietly erodes your purchasing power every single month, even as the headline rate of increase begins to settle. This creates a constant friction in daily life. Regardless of economic reports, groceries, insurance, and basic services feel increasingly out of reach for millions. At the same time, the broader economic engine is losing steam. Annualized GDP growth downshifted from 2.1% in the first quarter to just 1.5% in the second. That deceleration hits households immediately. By July, consumer spending hit a 7-month low, rising a mere 0.2%. While people are still buying essentials, the data suggests a significant pullback on major purchases as Americans become more cautious with their remaining cash. The U.S. is now navigating a dangerous vacuum, facing high prices on one side and stalling economic momentum on the other. The Federal Reserve acts as the arbiter for these two competing disasters, but recent data has pushed the central bank into a corner. Cutting rates to stimulate the slowing economy carries a massive risk. It could allow high inflation to become a permanent feature of the American landscape. Conversely, opting to keep rates high to finally break inflation threatens to fracture the economy's already weakening growth even further. Wall Street is pricing in the reality of this trap. Following the latest inflation data, expectations for a September rate hike moved higher. Fed officials are echoing this concern. Governor Lisa Cook recently warned that borrowing costs will likely need to move higher if inflation doesn't continue its downward path. Because the Fed is stuck in this position, everyday Americans are facing a future of stubbornly high interest rates on everything from credit cards to business loans. Despite these grim realities, stock market indexes remain surprisingly resilient, creating a strange paradox between Wall Street and the rest of the country. This disconnect stems from a simple truth. The stock market tracks specific corporate valuations, which often move independently of the underlying economy. A massive surge in AI spending is masking the broader economic cooling. Corporations are pouring billions into physical tech infrastructure, keeping investment numbers artificially high. This creates a fragmented economy. While the tech sector booms, the traditional industries that support most American households are steadily losing momentum. Headline stock numbers provide a false sense of security, hiding the real deterioration taking place in the everyday consumer economy. We see the most direct impact of this macroeconomic trap in the housing market, 0.68%. This has created a state of paralysis for potential homebuyers. Millions are waiting on the sidelines, hoping for a sudden drop in rates that may not arrive for a long time. Relying on perfectly timed interest rates ignores more critical factors like personal income stability and long-term debt-to-income ratios. Attempting to outguess the Fed's next move often leads to financial stagnation, stalling progress on personal goals while simply waiting for a macro shift that is completely out of your control. With the macroeconomic path completely uncertain, focusing on personal preparation offers more security than attempting to predict the next market cycle. A strong defensive strategy involves building a robust emergency fund, paying down high-interest debt, and avoiding large payments that could strain your monthly budget. For long-term investors, the offensive play is maintaining a consistent strategy rather than reacting emotionally to every new inflation report or job headline. Interest rates will fluctuate, and markets will rise and fall. These are inevitable cycles that no individual can influence. Maintaining strict financial discipline while the economy shifts around you provides a far more reliable advantage than any attempt to outguess the market.